Hello, everyone. Welcome and thank you for joining us for today's webinar, The Mid-Market Matters, Why Companies Must Rethink Customer Segmentation, brought to you by Technology Services Industry Association and sponsored by ServiceSource. My name is Ingrid Triago, your moderator for today. Before we get started, we just have a few housekeeping items. To maximize your webinar experience, click the question icon on the upper right corner of the registration and check your system's most recent versions of browsers and Flash Player. Update to the most recent version available for the optimal viewing experience. Audio will be delivered via streaming. You'll be in listen-only mode and you'll listen via your computer or mobile device. Webinar controls, including volume, are found below the presenter headshot area. To view your webinar, select your link to proceed to the player. And you can ask questions at any time by submitting your questions in the Ask a Question box on the left side of the webinar player. Feel free to enlarge your slides to full screen at any time by selecting the full screen button, which will appear on the top right area of the slide area. There will be an exit survey at the end of today's live webinar. Please provide your feedback on the content and experience by filling out the brief survey. And finally, a link to a recorded version of today's live webinar and access to download the PDF of the presentation will be sent out within the next 24 hours via email. Once again, thank you for taking the time to join us today. You can follow TSIA on Twitter at TSIA Community and use hashtag TSIA Webinar to contribute to today's conversation. I would now like to introduce our presenters today, Phil Nannis, VP Research Customer Success for TSIA, and Chad Line, Senior Vice President, Strategy and Corporate Development for ServiceSource. As with all of our TSIA webinars, we do have a lot of exciting content to cover in the next 30 minutes, so let's jump right in and get started. Phil, the floor is yours.
Thank you, Inga, and good day, everyone. As we think about today's topic, the macro discussion is absolutely focused on segmentation. And the first thing for you in the audience to know is that this is very much a common practice for customer success organizations. Now, we at TSIA identify a common practice as a benchmark data point above 50%. And the number of companies that actually have a segmentation strategy for their customer success function is close to 90%. But ultimately, what we want to know is, why is that important? The obvious answer is, often when companies start with customer success, there's a honeymoon period of initial investment, but ultimately the question is where to place those limited resources while also having a long-term plan in place to identify how to scale the organization. This means that the customer success leader and the organization has to think about the overall segmentation strategy and how to align and scale their teams. Now, TSIA has previously analyzed our own data, and we looked at the top quartile performance of customer success organizations based upon the supplier KPIs and metrics of dollar retention rate and dollar expansion rate. And we found several practices that were common within those top performers. Having a robust segmentation strategy was one of those. The metrics and results were telling, as we saw a plus 9% increase on retention rates and a plus 7% increase on expansion rates for that top quartile performers versus the rest of the survey participants. Now let's look at some TSIA benchmark data that evaluates the kind of segmentation that actually exists. The most frequent kind of segmentation is account size. This is typically based on a traditional pyramid approach that may also exist in your sales organization. And that could range from segments like an enterprise, the mid-market, which is a topic that Chad will speak on in just a minute, or even the small, medium business segment. And it's important to align that account segmentation to the overall strategy of the company. And it's also important to align that to the go-to-market, whether you're direct in a certain segment or you're using partners in an additional segment. The next kind of segmentation is your traditional geographic segmentation. Now, many CS teams are field-based and near the customer, but it's also important to think about language and cultural considerations across the globe, including throughout Europe and throughout Asia. Next is the quote-unquote strategic customer that may have high growth potential but does not have a high ARR today. And then there's other considerations for touch, whether that's high touch, low touch, or tech touch, along with product and application segmentation as well. Additionally, thinking about your CSM team in the spirit of domain and functional knowledge is becoming increasingly more important. If the executive contact at your customer is within a specific vertical like aerospace or manufacturing, having some level of domain expertise on that vertical is important. Okay, so now it is time to dig deeper into the account size segmentation discussion and specifically trying to understand why the mid-market is so important. And I'll now turn the call over to Chad Line from ServiceSource. So Chad, go ahead, take it away.
Phil, thank you for sharing that insightful data, and thank you for everybody that's joined the webinar today. I know that what Phil shared is just the tip of the iceberg in terms of research and information TSIA can provide. So I would encourage everyone listening to engage with Phil and TSIA on other insights that they can bring your business. As Inga mentioned at the kickoff, my name is Chad Line, and I am SVP of Strategy and Corporate Development at ServiceSource. I'll spare everyone a lengthy ServiceSource commercial, but before we jump into the second part of the webinar, I think it is worth calling out that ServiceSource is the market leader at helping technology-oriented companies deliver compelling and holistic customer journey experiences, primarily for their B2B customers. For companies like Dell, VMware, Salesforce, Microsoft, Google, and more than 50 other world-class brands, our inside sales, customer success, and revenue retention solutions help them find, convert, grow, and retain more than $9 billion of revenue annually from their mid-market customers. I'm sure I don't need to convince anyone on this call that customer success is a corporate imperative. According to the TSIA data, 62% of all companies surveyed report having a customer success function. With the ongoing shift to SaaS and consumption-based business models, the prevalence and growth of customer success is even higher, with 9 out of 10 subscription-based recurring revenue businesses having a customer success function. This focus and imperative on customer success comes from the very top of organizations. As one of the world's most valuable companies, Amazon has built a nearly $200 billion business that has grown at a 28% compound annual growth rate over the past decade. They have disrupted multiple industries and legacy business models, underpinned by CEO Jeff Bezos' vision to be the Earth's most customer-centric company. This customer success mindset permeates everything they do, from product design to R&D to the customer experience. Or take the case of Microsoft. Their Azure business grew 93% in the most recent quarter, and several of their cloud solutions are growing multiples faster than the broader technology industry. Their stock is up over 40% in the past year, and they now have a market cap of over $800 billion. In a recent interview on CNBC, CEO Satya Nadella was clear that the company's success is based on delivering customer success, particularly as the company accelerates its transformation to a subscription and consumption-based business model. And then there's obviously Salesforce, which was one of the early pioneers and adopters of customer success. Their subscription revenue grew 27% in the most recent quarter, and they are now on a $12 billion annual run rate. Chairman and CEO Mark Benioff explicitly called out customer success's impact in their May earnings press release, saying, and I quote, "Our relentless focus on customer success is yielding incredible results." So, CEOs and heads of market-leading companies are beating the customer success drum, yet many other organizations aren't realizing the full potential of customer success done right. In our experience, there are 3 key things that set apart customer success leaders from the laggards. I call these the 3 M's: markets, metrics, and mandate. Let's dive into the first one, markets. And what I'm referring to here is really customer segmentation. On the customer acquisition side, companies tend to spend a tremendous amount of time and effort doing hyper-targeting from a marketing perspective, slicing and dicing their prospective customers by dozens of demographic variables and other criteria. But once someone becomes a customer, the segmentation tends to become very simplistic. And that simplicity is really driven by the 80-20 Pareto Principle. I am paraphrasing the principle here a bit, as the 19th century economist Vilfredo Pareto originally wrote it in Italian. But effectively, the principle states that 80% of the effects you see come from 20% of the causes, hence the 80-20. You can see the Pareto Principle in a lot of areas, whether it's in the broader economy and the distribution of wealth, in sports teams and the distribution of athletic performance, and in business with customer segmentation. On the business side, the chart here highlights the Pareto Principle at work for an illustrative company with 1,000 customers that range in size from $1,000 to $10 million. The top 50 customers in the green area at the left, or 5% of the total customer base, account for 50% of the revenue. I'm sure a lot of us see this in our own businesses with a customer concentration at the top. The next 150 customers in the blue area, or 15% of the total customer base, account for another 30% of revenue. So combined between the green and the blue, you have 20% of the customers contributing 80% of the revenue. This is the Pareto Principle. While this principle is a financial reality for most companies, the common error that has been made is that this segmentation, done by size alone, which Phil shared with you, becomes the basis for formulating a customer success strategy. As Phil pointed out, most B2B segmentation is driven by account size. That segmentation often looks like this pyramid. Your largest and theoretically your most important customers are at the top. A lot of small accounts become the long tail at the bottom, and everyone else is rolled into the middle. Companies throw the kitchen sink at the top of the pyramid. They engage with field sales, account managers, customer success teams, and C-suite executives to provide multi-level coverage. The bottom of the pyramid is often served with a tech touch or self-serve model. And customers in the middle are forced to try to achieve their desired outcomes and value through the channel partners and resellers who sold them the product, software, service, or subscription in the first place. The flaw in this approach is that it often ignores the reality of where future growth and value will come from. Sure, your largest customers are critically important, and you don't want the revenue they generate to churn away, but these large customers are often suboptimal from a profit margin standpoint. These large customers often tend to be maximally penetrated from a share of wallet perspective, so there isn't much incremental growth that can be earned with them. And in fact, their scale provides them with leverage to negotiate pricing concessions that can often erode revenue over time. This is why the mid-market is so critical. It serves as the profitable growth engine for the future. So, if customer success is a corporate imperative from the very top of organizations, and the mid-market is the source of future value, then companies need to rethink where and how they are deploying customer success. Here's an example of how one leading subscription company allocated customer success resources based on account size. Bigger accounts get a more dedicated resource with a 1-to-2 CSM coverage ratio that you see at the top, while smaller accounts down in the 1 to 5 million range still get focus and attention with a 1-to-5 CSM coverage ratio. We see the similar approach across a variety of companies and industry sectors. But what this and other successful companies have done is they leverage the value of customer success into their mid-market accounts, recognizing them as the key to profitable growth. And so as you can see in the chart above, this company particularly and others that we've worked with have scaled their customer success teams down to 50,000 or even lower and have driven great success, revenue growth, and outcomes for their clients and customers by doing so. So we've covered the first M of markets and customer segmentation. Now let's turn to the second factor for customer success in the mid-market, and that is around metrics and accountability. In my role at ServiceSource, I spend a lot of time studying the strategies and financials of companies in a lot of different sectors, and it always surprises me to see the plethora of metrics that companies track and report. A number of VCs have had to write lengthy blog posts with triple secret decoder rings so people like you and I can make sense of all the metrics and acronyms. While these and other metrics are valuable, having too many can dilute the focus and impact of a customer success team. As I think about customer success, it is really a simple equation. The value of customer success is roughly equal to the change in customer lifetime value divided by the change in customer retention or customer success cost. Positive ROI on customer success comes from growing the value of your customer relationships at a faster rate than your costs to do so. Let's disaggregate that a bit more. Customer lifetime value can be treated down into three key outcomes that you see here. Number one, do they buy more? Two, do they stay longer? And three, do they refer more? Many customer success teams are unfortunately focused myopically on the second pillar of stay longer and are measured on churn and retention rates and customer health scores. These metrics are absolutely critical, but I would argue that they are more focused on preventing the bad, in this case churn, versus promoting the good, which is growth and expansion. Market leaders recognize that customer success teams can and should be critical growth engines by focusing on the buy more and refer more pillars. Attaching incremental products and services, upselling and cross-selling additional revenue streams, and proving value are key inputs to the buy more bucket, while driving references, referrals, and positive word of mouth create a flywheel for growth into new customers. So if you're able to help customers buy more, stay longer, and refer more, then your job's done, right? Well, not if that $100 million of incremental value cost you $150 million to get. This is where the second half of the equation comes in, your cost and investments in customer retention and growth. Like the previous slide, I like to disaggregate this down into three components as well: the cost of your people, processes, and platforms. Scaling customer success down to serve a $10,000 account in the mid-market takes a different rep profile, comp and benefit structure, and accountability system than it does to serve a $10 million account in the enterprise tier. Similarly, coverage ratios, engagement models, touch points, and motions are unique given the different scale, velocity, and customer demands in the mid-market. And lastly, there are investments in technology platforms and systems to improve efficiency, reporting, and accountability. All of these factors need to be rethought and customized for the mid-market. You can't copy and paste what you are doing at the enterprise level and expect similar outcomes to carry over in the SMB segment. If you want to build and keep your customer success organization as a source of revenue growth and value, as opposed to a cost center, it's critical to get the various inputs and levers dialed in correctly, and organizations like ServiceSource and TSIA can help in that regard. As we look to wrap up in time for questions, the third factor for customer success in the mid-market is the mandate. And here I would encourage you to go all in. We often see companies try small pilots or proof of concepts for customer success. J.B. Wood at TSIA refers to these as art projects. Staffing up a 5-person CS team is a fairly low-risk investment or financial commitment, but it is also likely to have limited reward. Building a large CS team and deploying it enterprise-wide is not an easy task, but the returns are worth it. As Confucius once said, better a diamond with a flaw than a pebble without. Market leaders have proven the tremendous value of customer success and have demonstrated the ROI of scaling it to the mid-market. I share this example of a company that went all in on customer success. They scaled their CS organization to more than 850 professionals and 3% of their total workforce, deployed it up and down their customer segmentation stack, and have seen best-in-class results on customer expansion and retention, leading to revenue growth of more than 25% annually as they cross the $10 billion revenue mark. Companies need to take a similar approach to customer success as they do to sales and marketing. Most companies would jump at the chance to spend $10 on sales and marketing to get $100 in revenue. If you're in the SaaS world, you are probably even happy to spend $150 on sales and marketing to get $100 of year one revenue. In the same vein, customer success should be structured and held to the same standard of accelerating top-line growth. As we wrap up, let me briefly recap. Phil showed at the outset that most companies allocate their customer success resources based on account size. We showed that the 80-20 Pareto Principle of market and customer segmentation needs to be rethought, as your future profitable growth and where customer success should be focused is in the mid-market. We talked at a high level about some of the key metrics that will allow you to prove the value and ROI of mid-market customer success to your CFO and CEO. And third, when you're having those budget requests and resource allocation discussions with your executives, we encourage you to go all in for a larger mandate. With that, Phil and I would be happy to get to some of your questions. I'll turn it over to Inga.
Great. Thank you so much, Chad and Phil, for a really, really insightful and informative presentation today. You shared some really, really powerful data around the topic of customer segmentation. So thank you very much for a fantastic session today. So as Chad just mentioned, we are coming to the Q&A portion of today's live webinar. If you have any questions for our speakers today, please ask those questions via the Ask a Question box on the left side of the webinar player. So first question is for Chad. Chad, in your presentation, you mentioned CRC. Could you tell us what that stands for?
Yeah, Inga, the CRC is a number that more people are talking about in the customer success world, and what it stands for is customer retention cost. Right, so a lot of businesses focus on an acronym you've probably seen or heard called CAC, C-A-C, the customer acquisition cost, which is how much they spend on sales and marketing to get a new customer in the door. And the key metric for customer success, because again, you're dealing with existing customers in the install base, is what does it cost then to not just retain that customer, the CRC cost, but to retain and expand them. And so those costs can be anything from your customer success platform, if you've got that on the technology stack, to your customer success team, their managers and overhead, the real estate that they occupy, and even portions of your marketing expense that might be dedicated to marketing towards that install base to drive upsell and cross-sell activity. So it's a fairly holistic number that includes more than just the salaries and benefits that you're paying to your CS team. So you get a true view of what that's costing you to deploy against your enterprise or your mid-market. And then again, allows you to figure out, are you getting an ROI on that spend by driving growth, expansion, and higher retention and renewal rates.
Great. Thank you so much, Chad. Next question is also for Chad. Chad, what is the role of the channel partner in the mid-market segment as it relates to customer success?
Yeah, great question, Inga. And obviously for a lot of businesses, maybe less so in the SaaS space, we're seeing that more there as well. Obviously, the channel partner community and ecosystem has played a big role in growth of companies in the tech space over the years. You see some organizations where the channel may account for 70%, 80% of their total revenue. And it's, again, a model that's worked well from the standpoint of distributing and fulfilling physical assets, so more of a hardware-centric model. Obviously, with move towards software, subscription, and cloud, that had less of an influence there. But what we see within the mid-market for companies, whether you're a hardware company, a software company, a medical device company, et cetera, is a lot of companies are trying to get closer to their customers. And so we mentioned at the outset when we showed that pyramid that, again, they deploy account executives, CEOs, customer success teams at the enterprise level, and they're lacking that visibility in the mid-market largely because of the role that the channel plays there of owning that customer. And one of the things that we've seen with a lot of our larger enterprise accounts is that they want to deploy customer success across the organization, but frankly, a lot of the channel partners, whether they're distributors, resellers, managed service providers, whatever the acronym or business model is, lack the resources and teams and capabilities to really invest in customer success at the channel partner itself. So we've seen a number of organizations that have taken it on themselves to build, whether they call them channel success managers, partner success managers, portfolio success managers, et cetera, where it's teams that help and effectively stand up a third-party a customer success team to help the channel deliver customer success for those customers in their install base.
Great. Thank you, Chad. Chad, this question is also for you. But Chad, what role does CSM variable compensation play for growth in the mid-market segment?
Yeah, can you say that one more time, Inga?
Yes. What role does CSM variable compensation play for growth in the mid-market segment?
Yeah, I think it plays a pronounced role. Again, if you're setting up CS with a growth mandate, which we believe is a best practice, again, we do see some organizations where CS is really just a new buzzword for customer service or account management and more of a reactive organization just trying to retain the revenue. But again, if you've established it, set it up with a mandate in the charter that CS is there to drive growth and expansion and drive incremental value from your install base, then it becomes more of a sales mandate, if you will. So obviously the teams need to have empathy, need to have strong relational skills in terms of being able to build rapport and relationships with the accounts. But they also have to have a growth mindset, and so that comes down to, we've had other webinars and thought leadership practices with TSA in the past that comes down to owning a number, and it's not just the retention rate or the churn rate. It's how do you drive growth and expansion with those, and so that is a sales metric. Whether the CS team is actually closing the upsell, the cross-sell, the expansion themselves, or are using that as a feeder into another team that's actually closing the business, they need to have that as a core piece of their KPIs and ultimately what they're comped on, which kicks into the variable component.
Thank you, Chad. This next question is also for Chad. But Chad, would you dissect differently mid-market based on geography, North America, Canada, U.S. versus global ops?
Yeah, good question, Inga. I would say yes, maybe less so in terms of North America. You tend to see a lot of the same structures in the U.S. and Canada, and somewhat within LATAM as well. Where you do see different engagement models tends to be in Europe and in Asia Pac. And again, that's largely because of language. So if you're trying to deploy a customer success team in Western Europe, you may be dealing with a need to provide coverage for 30 or 40 different languages as you scale down in the mid-market. So that becomes a different level of complexity, different kind of account structure, maybe shared resources, et cetera, to be able to handle that. Versus in the U.S., obviously you have more of a homogeneous market that you're dealing with there in terms of how B2B buyers procure, engage, and even the languages that they speak.
Thank you, Chad. Chad, this question is also for you. When you're looking at metrics, what is a customer success KPI that isn't as important to focus on?
Yeah, one that's not as important to focus on, I would say, again, there's a lot of metrics that are very important, and I'm not saying they don't belong on a dashboard, but I think one that gets overused or over-indexed to is around net retention rate. Again, if you pull up the 10Ks or the annual filings or listen to the analyst reports for a lot of companies, whether they're software or SaaS, you tend to see this metric being reported of we have a 110%, 120%, 130% net retention rate. And those are good numbers. What it does is it helps to account for upsell and expansion. But what can often be overlooked within that metric is what's happening from a gross churn standpoint. So a company can have a very high net retention rate because they've had one or a handful of sizable expansions within their install base. Well, they could be churning out a sizable portion of their of the logos or the accounts that they're serving beneath that. So again, it's a number that's important. Wall Street focuses on it. Companies should focus on it. CEOs are focused on it. But you also need to do the double click and then say, okay, beyond that, what is happening from a dollar-based churn perspective, a logo-based churn perspective on a gross level to understand if you're actually losing some money and opportunity and future growth potential at the backside. Again, you've spent so much money on a sales and marketing standpoint to acquire those customers in the first place. Don't let NRR, net retention rate, delude you into thinking that everything is all right when they could be walking out the back door and you've lost out on the investment you've made in them.
Thank you, Chad. So we have time for one more question, and this also is for Chad. Chad, what are some hurdles I should expect when I'm looking to engage my middle market customers using a CSM strategy?
Yes, in terms of hurdles, I'd say, I forget what slide number it is here when we can refer back to it for people, but I'd say it really comes down to how do you scale down? Again, a lot of organizations, the TSA data shows, 9 out of 10 subscription-based businesses have customer success. 2/3 have it, depending on what business they're in. But again, that tends to be at the enterprise level. So if you're trying to scale that down to the mid-market, I think it comes down to the 3 Ps that we laid out around people, process, and platforms. So the coverage models, the languages, the geographic coverage, comp and benefits, all of that kind of stuff. If you have a CSM that's in your $25 million plus enterprise tier handling 2 accounts, that type of rep profile or CSM profile and how they engage with systems and tools that they use and their capabilities are going to be far different than somebody that's handling handling 100 $25,000 accounts. And so I think that the error that we've seen a lot of people make is they're saying, hey, we're seeing great results from customer success at the enterprise level, Like I said before, they copy and paste and say, okay, we've got 10 people in the enterprise, let's put 10 of those same people at the mid-market or 20 of those same people at the mid-market, and they don't change the people, process, and platforms to really address the unique needs and circumstances and velocity that the mid-market requires. So it takes really a separate, entirely different business model, and people need to be cognizant of that.
Thank you so much, Chad. So we are coming to the conclusion of today's live webinar. I'd like to take this time to give the audience a couple of quick reminders that there will be an exit survey at the end of today's live webinar. Please take a couple of minutes to provide your feedback on the content and experience by filling out that brief survey. And finally, there will be a link to the recorded version of today's live webinar and access to download the PDF of the presentation that will be sent out to you within the next 24 hours via email. I'd like to take this time to thank everyone for taking time out of your busy schedules to join us on today's webinar, The Mid-Market Matters, Why Companies Must Rethink Customer Segmentation, brought to you by TSIA and sponsored by ServiceSource. My name is Ingrid Triago, your moderator for today, and look forward to seeing you at our next TSIA webinar very soon. Take care, everyone.